So let us start from the beginning and understand exactly how we got here. Let that number sink in for a moment. 34 trillion. That is not a typo, and it is not an exaggeration. It is the official figure sitting on the books of the most powerful economy in the world. But here is the thing. The number itself is not even the most alarming part of this story. What should truly capture your attention is what happens next. What happens when the systems holding all of this together begin to strain under the weight? What happens when the global financial structure that has quietly supported this level of borrowing can no longer sustain it? These are not hypothetical questions reserved for economists in closed-door meetings. So debt itself is nothing new. What is new, and what makes today's situation worth paying close attention to, is the sheer scale at which modern governments are now borrowing. Government debt is not a modern invention. For centuries, nations have borrowed money to survive and grow. Kings borrowed to finance wars. Empires borrowed to build roads, aqueducts, and trade routes. In the 1800s, countries borrowed heavily to fund railroads and industrial expansion. During the Great Depression, governments borrowed to keep their economies from completely collapsing. Borrowing has always been a tool that nations reach for when the cost of doing nothing outweighs the risk of going into debt. In many ways, it has been a cornerstone of how civilizations have managed crisis, ambition, and growth. Now let's zoom in specifically on the United States, because the numbers here are truly staggering. Back in 1980, the total national debt sat at just under $1 trillion. That figure, which once seemed enormous, is almost unrecognizable compared to where things stand today. The debt has now surpassed $34 trillion, representing one of the most dramatic financial escalations in recorded history. To put that in perspective, the debt has multiplied more than 30 times over in just 4 decades. This wasn't a gradual, steady climb. It accelerated sharply during periods of war, economic crisis, and major government expansion. Each decade brought new pressures that pushed borrowing higher and higher. What makes today's levels genuinely unprecedented isn't just the raw number itself, it's the speed at which that number grew and the structural dependencies that have built up around it. This trajectory is what has economists and financial analysts paying very close attention. But as we will see, that logic only holds under certain conditions. The answer comes down to 3 fundamental reasons. First, borrowing is used to stimulate economic growth. When private spending slows, governments inject money into the economy to keep activity moving, create jobs, and maintain consumer confidence. Second, governments borrow to respond to national and global crises. Wars, pandemics, and financial emergencies demand immediate and massive spending that tax revenues alone simply cannot cover. Third, borrowing finances long-term infrastructure and development projects. Roads, bridges, energy systems, and public institutions require enormous upfront investment, with benefits that stretch across decades. In each of these cases, borrowing is not viewed as reckless behavior. When economies collapse, governments do not wait. They spend. During the 2008 financial crisis, the United States launched hundreds of billions of dollars in emergency bailouts to prevent the banking system from completely unraveling. Then came 2020, and the pandemic triggered one of the largest spending surges in American history. Trillions of dollars were deployed through stimulus checks, business relief programs, and expanded unemployment support. These were not optional decisions. Policymakers believed that without aggressive intervention, the economic damage would be catastrophic and long-lasting. The pattern is consistent across decades and across countries. When a crisis hits, borrowing becomes the immediate answer. There is rarely time for debate or restraint. The priority becomes survival, and debt becomes the tool. What makes this significant is not any single emergency response, but the fact that each crisis leaves behind a higher baseline of debt that the next generation must carry forward. And that gap is precisely what makes the road ahead worth examining very carefully. Debt itself is not inherently dangerous. Governments, businesses, and individuals borrow money all the time, and when managed responsibly, debt can be a powerful engine for growth and stability. The real danger does not come from borrowing. It comes from what happens when borrowing grows faster than the economy itself. Think of it this way. If your income grows alongside your debt, the burden remains manageable. But if your debt races ahead while your income stays flat or grows slowly, the pressure becomes unsustainable over time. This is exactly the situation that economists and financial analysts are watching closely when they examine the trajectory of United States debt. The gap between how fast the economy grows and how fast debt accumulates is widening. It is the core structural vulnerability embedded in modern government debt levels right now, and it deserves serious attention. When debt grows faster than the economy, governments face a brutal mathematical reality. The interest payments on existing debt begin consuming a larger and larger share of government revenue. To meet those obligations, governments must borrow additional funds, not to build roads or fund schools, but simply to pay the interest on money already owed. That borrowed money then generates its own interest, which requires even more borrowing. Round after round, the cycle deepens. Think of it like carrying a credit card balance where your minimum payment never actually reduces what you owe. The principal keeps climbing while the interest compounds relentlessly. Economists describe this as a debt spiral, and escaping it becomes exponentially harder with each passing year. What makes US debt uniquely consequential is its deep connection to the entire global financial system. The US dollar is the world's reserve currency, meaning most international trade, oil contracts, and cross-border financial transactions are conducted in dollars. Countries around the world hold US Treasury bonds as safe assets, treating American debt as a foundation of global financial stability. This gives the United States enormous financial influence, but it also means that any serious instability in American finances would not stay contained within its borders. When the anchor currency of the global economy shows signs of stress, the effects ripple outward immediately. Commodity prices shift, exchange rates fluctuate, and investor confidence across international markets begins to waver. This is why economists and foreign governments watch US debt levels so closely. American fiscal health is not simply a domestic policy matter. It is a concern shared by virtually every economy on the planet. It becomes everyone's problem, almost overnight. The consequences would not stay neatly within American borders. When the world's largest economy shows signs of instability, the effects travel fast. Foreign investors might begin pulling back from US Treasury bonds, which are currently considered one of the safest assets on the planet. If demand for those bonds drops, borrowing costs rise, and that pressure feeds directly back into an already strained debt cycle. International trade, which is largely conducted in US dollars, could face serious disruption. Emerging economies that rely on dollar-denominated loans would feel the squeeze almost immediately. Stock markets across Europe, Asia, and beyond would likely react with sharp volatility. The interconnected nature of modern finance means that a crisis of confidence in America is not a local problem. History shows us that unsustainable debt cycles do not last forever. At some point, they resolve. But the path to resolution is rarely painless. Looking back across centuries of economic history, three distinct outcomes tend to emerge when governments can no longer manage their debt burden effectively. The first path is austerity. Governments deliberately cut spending, reduce public programs, and tighten budgets to bring debt under control. The second path is currency inflation. Governments print more money, effectively reducing the real value of what they owe, but at a broader cost to the economy. The third path is debt restructuring. Governments renegotiate the terms of their existing obligations, seeking relief from creditors through modified repayment agreements. These are not theoretical possibilities. Each has played out in real economies across different eras, and critically, none of these paths comes without serious consequences for the people living through them. Looking more closely at the austerity path, the idea seems straightforward on the surface. Spend less, reduce the deficit, and gradually bring debt under control. But the reality is far more complicated. When governments cut spending, they often reduce funding for healthcare, education, infrastructure, and social safety nets. These are not abstract budget lines. They represent real services that millions of people depend on daily. Reduced government spending can also slow economic activity, which ironically shrinks tax revenues and makes debt reduction even harder to achieve. Countries across Europe experienced this painful cycle following the 2008 financial crisis. Beyond the economics, austerity demands something that is historically rare: sustained political will and genuine public tolerance for sacrifice. Populations tend to resist prolonged cuts, and governments face enormous pressure to reverse course. This makes austerity a theoretically sound but practically fragile solution to the debt problem. This path demands extraordinary precision and discipline from policymakers to avoid triggering broader economic instability. When a government increases the money supply, the real value of its existing debt effectively shrinks. On paper, this sounds like a clever solution. If you owe $1 trillion but inflate your currency significantly, that debt becomes easier to repay in nominal terms. However, the consequences for everyday citizens can be severe. As more money enters circulation, each unit of currency buys less than it did before. Groceries, housing, fuel, and basic necessities all become more expensive. Wages often fail to keep pace with rising prices, quietly draining the financial stability of ordinary households. History offers sobering examples, from Weimar Germany to Zimbabwe, where aggressive money printing spiraled into hyperinflation and economic collapse. For these reasons, debt restructuring is widely considered a last resort, one that trades short-term relief for long-term economic credibility. This approach involves a government going back to its creditors and renegotiating the original terms of its debt. That might mean extending repayment timelines, reducing interest rates, or in more extreme cases, asking creditors to accept less than the full amount originally owed. On the surface, this can sound like a practical solution. It offers immediate breathing room when a government is struggling to meet its financial obligations. But the consequences that follow are serious and long-lasting. When a nation restructures its debt, it sends a clear signal to global markets that it could not honor its original commitments. Credit ratings fall sharply. Borrowing costs rise. International financial relationships become strained or broken entirely. The stakes have never been higher. The global financial system has weathered devastating crashes, world wars, sovereign defaults, and currency collapses. Each time, economies eventually stabilized and rebuilt. That track record might suggest we have little reason to worry now, but that reassurance only goes so far. What makes today's situation fundamentally different is not just the size of the numbers involved. It is the sheer complexity and interconnectedness of the modern debt environment. Dozens of major economies are carrying historically high debt loads simultaneously. Interest rates, currency values, and bond markets are all deeply entangled across borders. Who can provide personalized and appropriate guidance? But understanding how these forces interact has never been more important. The decisions made by governments today will shape the economic landscape that all of us navigate tomorrow. Whether the path forward involves austerity, inflation, or restructuring, the consequences will touch everyday lives across the globe. Staying informed is one of the most powerful tools available to anyone trying to make sense of what lies ahead. Please note that everything discussed in this video is intended purely for informational and educational purposes only. Nothing presented here constitutes financial or investment advice of any kind. The topics covered are meant to help viewers develop a broader understanding of macroeconomic concepts and historical patterns.